The two reports that IEEFA recently came out with are on reassessing oil in Uganda and the climate resilient development in the country to essentially assess the financial returns from the emerging oil projects and especially stacking them against the ongoing price volatility and the transition of the global oil sector. On the panel today, we have report authors Matthew Human, Will Scargill, and Gaurav Upadhyay to discuss the key findings of the report with us. Matthew is an independent consultant working in collaboration with IEEFA. He's a senior analyst and consultant with more than 15 years' experience at the intersection of climate risk, investment, and emerging market development policy. He's also been working on and off on the case of Ugandan oil for half a decade. Will Scargill is an independent consultant working in collaboration with IEEFA. He's an economist with over a decade of experience in the energy and climate transition space. He also holds a senior role providing climate risk advisory and consulting services in the investment industry. Gaurav Upadhyay is IEEFA's energy finance analyst, India Sustainable Finance for South Asia. He has over 12 years of experience implementing large-scale development initiatives in diverse sectors, including climate finance, just transition, and renewable energy. I'll hand over to Will and Matthew for the presentation on the two reports. Post that, we'll do a moderated panel discussion with the authors. Over to you, Matthew. Thank you.
Thanks very much. Good afternoon, good evening, good morning to you wherever you are. Yeah, we're going to handle this myself and Will when it comes to the presentation. Will, can you please move to the first slide? So why are we talking about oil in Uganda? It's been a long time coming. Towards the end of this year, perhaps the early 2027, we'll finally start to see some barrels being produced from the Kingfisher and Tilenga fields. And this is a resource that could produce up to 250,000 barrels per day. And it's been a topic of intense speculation and analysis over the last nearly 20 years since it was determined that there were commercially recoverable amounts of oil for various reasons, in part because it would be one of the first significant resources in East Africa, and then more recently because of the particular challenges that Uganda is going to face through by exporting the oil through the East African crude oil pipeline, the EACOP, to Tanzania to the global market. So that's a particularly challenging infrastructure project, nearly 1,500 kilometers, that's being built at the same time as the work on the resources. Construction which started in 2021, and at the time with first oil projected in 2025. So this has really been a story of continued delay and uncertainty over 20 years. I think just to really down to the complexity of the project. So after many years of exploration, in 2019, when I first started looking at this project, it looked like the companies involved. So there's the French investor Total Energies, the China National Offshore Oil Company. It looked like they were about to pack up and go home. This was a large but marginal project with a waxy crude that makes it expensive to refine, and crucially with a very high fixed infrastructure cost, the $3.6 billion US expected to be spent on the EACOP pipeline. And the project only went ahead because the investors were able to secure a renegotiation of the commercial terms in their favor. And even despite that renegotiation and the investment that's been going on since 2021, there has been further delay in part due to the inavailability of project finance before the pipeline construction started, and now due to significant cost overruns. So you'll see on this slide that the latest projections for the EACOP pipeline is that it's going to cost more than 5 billion US, up from 3.6 billion. So despite that, this is all going ahead. Significant project risks. And if you move to the next slide, please. We've also seen some massive shifts in the market that is going to be taking the oil produced from these projects. And this is an issue that all new oil supply assets have faced in recent years, which is uncertainty around future demand. What you see on this slide on the left-hand side is how the International Energy Agency's estimations of electric vehicle deployment have changed dramatically over the last 5 or 6 years, with ever increasing expectations of electrification of transport. Why is this happening? Well, there's probably some parts that are connected with climate action, right? A shift to electric vehicles has been a major part of many national policies. But it's not just this. And many have expressed some doubts with geopolitical volatility over the last few years that climate action would really continue at the pace that it continued before. What we've actually seen over the last year or so is that perhaps with the US to one side, we continue to see an acceleration of electric vehicle deployment. Electrification of economies, particularly in countries that are major consumers of oil and which don't have significant domestic resources. So particularly in China, certainly in the EU, it's even starting to happen in India as well. Electrification as a hedge against geopolitical volatility. And what does that all mean? Well, it means that long-run demand projections have started to come down and down. And on the right-hand side of this slide, you can see how some of the more recent oil price projections for the short term have also been starting to come down and down. And so what it means for our projects that we're talking about here, if we move to the next slide, is that expected financial returns will already be significantly lower than expected in 2021 when the final investment decision was taken. So that's lower demand and lower prices, lower revenues, in addition to those higher costs from the delay and the cost overruns, meaning that the expected returns are going to be quite a bit lower than the investment case. And here you see the dotted line being the typical expected returns for a new oil supply project. And for Total Energies, the large listed company, one of the largest investors in new resources in Africa, even before any of the global transition dynamics that we're going to explore in future slides, we are seeing that returns are significantly lower. And so it calls into question a whole series of issues. For example, why the company went ahead with what was already quite a marginal project. What sort of sensitivity analysis has the company been performing around those investment decisions, particularly when it comes to the future decarbonisation acceleration? And does the company have any plans for any future actions to try and increase that return, potentially via divestment? So many questions there that can be asked for Total management. So I'll pass over to Will to take us through the decarbonisation and transition analysis.
Thanks, Max. So as Max said, the accelerating technology-driven transition has already depressed some of the outlook for the oil price in kind of base case scenarios. But as that acceleration of low carbon transition trends continues, that's also likely to mean that the future global oil price expectation today is likely to be too high, and global oil prices may be much lower than are currently expected, even in our base case. So to assess the impact of this in our modeling, we ran two scenarios with lower global oil prices. One was a scenario where prices were kept flat at $50 per barrel in real terms. That's what we call our moderate transition scenario. And we also um, modeled a more aggressive scenario where oil prices were significantly lower in the long term, based on the IEA's net zero emissions scenario. So, notably, one of the key things that we found in our moderate transition scenario is that returns for investors may fall below the cost of capital, meaning that the returns are not just the project might not just be disappointing for an investor like Total Energy, but it could be actually value destructive for Total Energy's investors. So significant questions around the overall viability of the project if expectations of oil prices now are too high and the accelerating transition does drive lower oil prices. But really, investors are the more protected of the parties in this equation. And the biggest impact of the lower oil price scenarios would be on Uganda, actually. In these projects, government revenues really only increase significantly after investors have already recovered their investments. And this means Uganda earns their returns later, with oil revenues to Uganda are expected to peak in the early 2030s. But by that time, with the electrification of the global economy continuing, by that time, price risk is higher. So what that means is that Uganda's value from the oil developments falls significantly in the accelerated transition scenarios, and than uh, the much more than the value for investors. And the value of Uganda's income from these oil developments falls by over 50% in the net zero emissions scenario, compared to in the base case. So Uganda faces potentially a lot less revenue than expected and over a shorter period. And that would mean that potential contribution that these investments and the oil revenues could have to the country's development may be much more limited than expected. So in order to manage oil revenues, the government of Uganda had put in a rule that would limit would mean any oil revenues above 0.8% of non-oil GDP. That's about $500 million today. Were invested in a long-term fund for future generations, the PRIR. But in an accelerated transition scenario, we found that up to 70% less was invested in the PRIR because of the lower oil revenues overall. And that really limits the potential for there to be intergenerational impact on for Ugandans from the oil industry. The government would still have revenues that would be significant to the budget from the oil industry, but the key thing is that those revenues in an accelerated transition scenario, you can see on the chart here, they're peaking at about $1 billion annually. They would be unlikely to be as transformational as expected. And Uganda's really bet quite a lot on these oil developments. There's been significant amount of public funds invested, not only in ECOP, but in enabling infrastructure. And so whether all of these investments prove a net benefit for Uganda will depend a lot on potentially how this potentially much smaller group of pool of revenues may be spent. In anticipation of these oil revenues, the Uganda National Oil Company is set and planning to invest in a refinery partly financed by a loan from oil supplier Vitol. But based on our understanding of the commercial arrangements around these and the financing and the project itself, we feel that the project and the financing behind it could exacerbate the risk that Uganda faces to the oil industry and to the benefits that it gets. The headline interest rate of the loan is pretty low compared to government borrowing, but it's repaid over a relatively short period. And crucially, the loan is secured against Uganda's oil revenues, and the repayment of the loan would have primary would be would have primacy in terms of use of oil revenues. So an accelerated transition could mean lower profits for the potential refinery project, and repayment would therefore depend on a smaller than expected pool of oil revenues, as we've seen in the earlier slides. We found in the moderate transition, even if the refinery project's on time and on budget, the refinery and loan repayments could consume 40% of Uganda's oil revenues through 2032. That means much of Uganda's economic benefit from the oil sector revenues would now be contingent on the success of just this one big project. And so that comes with a lot of potential risks. The refinery does have clear potential benefits and it has potential to improve the reliability of energy supply, further trade balance benefits, local jobs, and reasonable financial returns in the base case. And there are clear reasons why it has historically appeared as an attractive option for Uganda to go ahead with. But these benefits are very sensitive to major risks around the project, including cost overruns. In the refining sector, cost overruns are very common. For example, Nigeria's Dangote refinery cost around double the original estimate. We've already seen earlier in the presentation the ECOP project is expected to cost much more than the original expectations. So major project risk in Uganda as well. And also, as well as risks around cost overruns, there's the risk of the impact that the accelerating transition will have on the oil market. So the chart on this slide shows the net benefits of the refinery. And in the base case, although the diversion of crude to the refinery means less tariff income from ECOP, this is more than offset by Uganda's share of refinery profits and taxes, and it makes a significant value for Uganda. However, there is a number of plausible scenarios, and we've modeled one here, which is of a cost overrun and the moderate transition scenario, which could potentially wipe out benefits. The refinery doesn't appear commercially viable below around $50 a barrel, and that's seems to be reflected in the fact that Uganda's had to secure financing against its oil revenues rather than a conventional project financing model, and that it looks set to agree terms with its co-investor Alpha MBM that could give that foreign investor much more protection against commodity price risk than Uganda. But these agreements that Uganda seems to have had to, or terms that Uganda seems to be having to agree to get the refinery running, mean that Uganda is potentially left with a lot of the risk around the refinery. And there's significant potential for the project to backfire, either wiping out much of the benefits that could come from oil revenues, and or locking in the country into an expensive energy paradigm. And with that, I'll hand over back to Matt.
Thanks, Will. So just to recap, this is a big bet on an individual sector, and many of the potential benefits from the oil reserves seem like they're going to be dependent on the success of this one asset, if everything goes ahead as is currently planned. Um, and it's, you know, the context in which Uganda is making these decisions has changed significantly over the last 10 years. What we see on this chart is that public debt has expanded much faster than public revenues. Uganda's public finances have been weakened by external shocks, including increased US interest rates, higher energy commodity prices, and has resulted in some downgrades of the country's sovereign credit rating. Um, and so what that means is, generally speaking, less fiscal resilience to shocks. And if the oil industry, we've seen on the previous slide, there's plausible scenarios in which the particular project benefits don't materialize. But if yeah, and we should say too that Uganda here has a 40% stake in the construction costs. Significant cost overruns could, if they were to lead to further sovereign rating downgrades, could create a vicious circle of increasing borrowing costs and inflation that could have much broader impact on Uganda's ability um, to finance its overall development plans at reasonable cost. So it's a particularly bad time to be taking single big bets on particular sectors that are linked to external markets. So we've taken a look at some of the other potential options if the country was going to delay or perhaps not even go ahead with the refinery. If we can just move to the next slide, please. And Uganda does have some options there. It's for Uganda to choose between those options. And I would say many of the things that we've investigated were already included within the very extensive fourth national development planning process. So what we're suggesting is applying a series of additional criteria, particularly when it comes to spending public funds, um, on things like improving access to modern energy services and climate resilience as a minimum, as investments that potentially put the Ugandan economy, the Ugandan financial system at less risk and have the potential to help the country achieve a more resilient future. Here are these four considerations. I'll run you through them briefly. So first one, investment size. So many of the investments in Uganda's economy in electrified industrialization, these are smaller in size, individually speaking, than the refinery, and therefore the risk if something goes wrong, delays, cost overruns, lack of access to finance, much less significant from a systemic perspective. Some of these other investments are ones that take less long to construct, pay back over a shorter period, and that's also reflective of general lower complexity. And the good news with those types of investments is that they put less pressure on the system, right? There is less time for that it takes for the revenues to come in to pay back any debt that's taken out in relation to those things. Third one is risk allocation and financing cost. We've seen here how Uganda's weaker public finances have led to weaker negotiating power and perhaps what seems like a willingness to accept terms that place a large amount of risk on the Ugandan economy over the long term. Um, I would say uh, again, a more diversified strategy would also give some access to some concessional finance, particularly when it comes to climate resilience, which would reduce exposure again and maintain some flexibility over the long term. And then finally, there's the question of climate risk exposure. We are suggesting that Ugandan government, which is one of the major players in the international coalition of finance ministers for climate, um, walks the talk by reviewing some of its major potential investments for transition risk in the way that we've done here with the oil sector, and also really starts to add appropriate weight to climate resilience, mitigating physical risk, which given that the sector with the largest number of jobs in Uganda, agriculture, and much of the existing power generation capacity in hydro are particularly climate vulnerable. So just moving to the final slide, what this means is, we are suggesting one of our key recommendations is an amended type of planning process, which recognizes the fact that we're in a particularly volatile environment now. We've got many new different types of risks materializing, and especially as Uganda becomes increasingly more integrated with the regional and global economy, we need to shift away, or we would advise trying to shift away from a planning process that sets static priorities every 5 years. Um, and in doing so, we would expect that Uganda potentially considers a more diversified strategy. And it's a good idea to do one last review as to whether this refinery project is really where it makes sense to to make another concentrated bet, another concentrated commitment of public resources. So those are our key findings or key points for this slide here sets out just the 6 key findings from the 2 reports, which you can find and download from the IEEFA website. Thank you for your attention. I'll pass back to you, Purva.
Excellent. Thank you so much for these absolutely, wonderful insights. I think they'll help everyone understand the report better. Again, for the attendees, if you want to go and look at the reports, you can download from the IFA website as well. And I would also link them here in the chat in a minute. I would also encourage the attendees to put in any questions they have on Matthew and Will's presentation in the Q&A box, or while we are discussing anything else that comes up, please feel free to add it in the Q&A box. So I think it was very helpful to understand a little bit, more nuance of what really is happening in Uganda, especially with the oil project at the moment. I will start with you, Matthew. From what I understand, the country has some really ambitious national development plans. As you also pointed out, it's looking at, the fourth national development plan to 2030, and oil was to be a very significant economic role in that. But how you've highlighted, it seems the revenue might be significantly delayed and impacted by the geopolitical and climate concerns. What are the broader implications for Uganda of this oil sector challenges?
Well, I mean, there's been a lot, and the delay has been happening at a time of this increasing volatility, right? So, in the first instance, lower revenue, lower economic growth than expected. Um, if you go back and take a look at some of the reports that the IMF had put out in the previous program, the expectation is of oil revenue starting to come in already, and things already being a little bit tight, even with that timetable. So what that's meant is that we have a much higher amount of debt to GDP already, very early in this fourth national development planning period, and some liquidity issues, which have resulted in the sovereign credit downgrade. We saw that, we see again that Uganda now post-election is seeking another IMF program. Um, there are discussions around what other types of core spending have needed to be delayed or deferred or even cancelled, in order to continue to service an increasing amount of public debt, and Uganda has been struggling to get access to concessional debt in recent times. So, I mean, these are the things that have really contributed to this weaker public finance position, and the other issues that I was mentioning.
Perfect, thank you. And I think Will, you noted in the presentation that with the accelerated electrification of oil demand, even the accelerated transition scenarios, the Ugandan oil reserves might be worth up to 34% less for foreign investors and more than 50% less for the country itself compared to the current expectations. What would you attribute the key reasons for that have been?
So I think, of course, the overall impact on the value of oil reserves is the impact of Uganda selling on oil on the global market, and so exposed to global prices. And so the question then becomes how that split of the risk to the value of oil reserves is between investors and the government. And really, the higher risk to the government's oil revenues is a feature of how industry contracts are typically structured, and have historically needed to be structured in order for governments to be able to secure investment, and for investors to go ahead with what they feel is a reasonable return. And as Matt said, I think early in the presentation, there have been some indications that Uganda has had to make some additional concessions to in terms of terms, to get the projects moving, and to get that final investment decision from Total Energy and CNOOC. We don't have the details of those final terms. Those haven't been published, but indications from parliamentary testimony suggest that may have included the increase of a cost recovery limit, which is the amount of oil the companies can take to recover their costs before any of the profits would be shared to Uganda. So that all means that there's potentially even more downside risk for Uganda in an accelerated transition scenario, even more than that risk that we've highlighted in the report here and in the numbers there. And it's a feature, as I said, it's a feature of the commercial interest and the commercial negotiations from the investor's side. But really, the outcome is that some of these commercial negotiations then potentially can really change the risk reward picture for the host country like Uganda, particularly when one considers any other kind of wider environmental costs, that may impact the country and not sit on that balance sheet.
Yeah, thank you. I think the contract structure, as I read in the report, is a very unique and interesting feature which probably does not work well for the country per se. And I think developing countries face this challenge, are increasingly facing this challenge. And I would like to bring in Gaurav for that. So, Gaurav, we are seeing that it's becoming increasingly challenging for developing economies to balance their fiscal needs and also the climate considerations. And what do you think should be the priorities in making this choice if we take Uganda as an example?
So for developing countries like Uganda, I would say the challenge is not choosing between the fiscal priorities and climate goal, but deciding how to sequence the investments and manage the long-term risk. So the climate consideration should be treated as a part of fiscal risk management, not as a competing objective. If you say in most of the countries, if you see today, the low carbon electricity as well as the mobility systems are now cheaper than build the large meet the fossil fuel alternatives, which Will was talking in the previous presentation. And Uganda is well placed right now so that it can shift from limited, very large fossil fuel investment to the cleaner opportunities. And and make the climate vulnerability right now the Uganda is facing in both its if you see the job perspective, the agriculture is the largest sector. Around 60% rural jobs are in agriculture. And if you see the installed capacity, the hydro capacity is the main, electricity generation. So that is around 80%. And both are very vulnerable to the erratic pattern of the rainfall. And that's why Uganda has to, make the resilience one of the main agenda while it is developing and, using its scarce public finance. So it has to use its limited public finance very strategically and aligned its medium-term objectives based on the climate priorities it has. Yeah.
That's absolutely correct. I think for developing countries per se, it's very important to optimally reutilize these resources, and it becomes even more important for countries like Uganda, which are probably not which are exposed to a higher risk due to the of the weather factors and climate factors due to the ongoing energy mix and the balance they have. I think I'd like to bring Matthew in here. One of the key findings of the report is that it'll be ideal to not lock the country in any one economic paradigm, like what we were discussing with Gaurav right now as well. And it would be, better to focus on diversifying the economic activities and income for the country, and also something that would allow it to be more, climate resilient. So how do you think how realistic it is for Uganda to achieve this, and how would you factor in the growing climate concerns in the suggestions that you would make for the country?
Yeah, I mean, this question of what's realistic is something that often comes up in the discussions also with officials and with financiers. It's fair to say that not all countries have the same set of options. Uganda, because of its limited power generation capacity, limited industrial base, is slightly restricted in the way in which it can access, some of the emerging global trends when it comes to emerging technology and things like that. But there are still ways in which it can diversify its strategy, right? So the first one is around, and we've heard about. There's some questions also around the Vitol loan. Um, you know, we you know this question of taking out large amounts of debt and pledging significant amounts of potential future revenues. Those are ways that reduce your financial flexibility over time. Um, and so, you know, that's one area where they might want to think again. Another area might be, the size of any large bets that they take on particular sectors, whether it's oil or anything else, to be honest. Um, and then even for those sectors where they're developing and as they're gradually building up the industrial base, considering lower risk markets. There was one question out there around um, which markets the oil is going to be sold into. There are major potential opportunities for Uganda engaging in growing intra-African trade. So I would say there's some looking quite closely at regional markets. Um, but we cannot ignore the question of climate resilience, which, and there's a World Bank report that came out earlier this year that had Uganda as the 14th most climate vulnerable country in the world. Um, Uganda's probably the primary objective in its national development plan, as far as I read it, is around pulling people out of subsistence agriculture. And so, particularly given that it might be possible to get some lower cost concessional financing here, it would seem to be a no-brainer to really prioritize these sorts of things, especially as they might have less of an impact when it comes to debt. And I think that there's a real risk if Uganda pushes ahead with the same strategy, given everything that we're seeing, that in search of energy independence, which I know has been a kind of a major part of the story over 20 years, you just trade one form of dependence on energy for another form of dependence on commercial capital, um, and the foreign policy interests of the co-investors. And I think that's something that really needs to be looked at more closely.
Yeah, I think that was one of my key takeaways from the report as well, that how do you trade your dependencies, and where could you make the right and optimum choices. There's so much that we're talking about, and we're talking about climate resilience, we're talking about diversification of economy, we're talking about over dependence on oil as a problem. How do you think all of this could affect, and then there are also concerns about foreign investments, like Matthew is saying that if there is access to concessional investments, then how do you think that, everything affects the country's ability to attract the financing it needs for its development plans? And I would also like to, add on a question that probably you've already answered in the Q&A box, but in case you want to add something, that was asked on how much would be earned annually in a moderate transition scenario. So how do we look at these transition scenarios from the investment and earning perspectives?
Thanks, Perfect. So I will just on the amount to earn in the moderate transition scenario. So in a in our base case, we saw Uganda earning about a bit over $2 billion by kind of 2032, and that falling as then the oil production decline. In our moderate transition scenario, we see oil revenues at about half that, at about $1 billion at their peak. And then by the late 2030s, when oil production has declined significantly, then Uganda's revenues from oil would be about would be around half of that. So that revenue declines relatively quickly. Just to note, this is from the upstream developments and the ECOP, not including um, any income from the refining project. Um, on the financing side of things, I think it really is a challenging environment for Uganda at the moment. They have a poor sovereign credit rating, and there's less development finance available in the world, with policies having US significant um, the US having significantly cut back aid budgets, and so it's a challenging environment for attracting finance. Um, but I think a couple of things that we've highlighted in the report are, firstly, kind of a low headline rate is not always the best, particularly when that's in a commercial arrangement, and the terms may be structured so that that kind of low headline rate um, could obscure some other contingencies and things that could prove restrictive for Uganda. Um, I think the other thing is that it's really important for in this challenging environment. It becomes even more important that Uganda takes note of the risks that can come with particular investments. And so, say, taking on a if the Uganda goes ahead with the refinery investment, and it backfired and kind of hurt public finances, that could even further um, challenge the country's ability to raise finance at a reasonable rate, and hurt the country's development prospects. So there's a lot to consider there, and concessional finance, as Matt mentioned, can play a role. And importantly, that can often provide a multiplier effect to the amount to any public funds that the government is putting in, and is particularly available for, say, green energy or climate resilience projects. And concessional finance can also be really important for developing countries when looking at capital intensive, climate resilient developments. Say renewables are a lot more capital intensive rather than commodity intensive compared to, say, fossil fuel fired power plants. And that means that while, say, in developed markets, renewables can often are already a lot cheaper than fossil fuel fired power plants. Cost of capital in the developing world can mean that that position is reversed, and because of the cost of capital. So as Uganda looks to develop in a resilient way, then concessional finance can really play a role in being able to take advantage of new technologies and take advantage of technologies that have become cheap over recent years.
Thanks. I think that's a perfect segue into my next question, and for which I'd like to bring Gaurav in. You spoke about new technologies. You spoke about concessional finance being a multiplier, and those are things that Gaurav, a lot of developing countries now have started multiple actions and implementing various schemes to introduce new energy technologies in their countries. Are there any lessons that Uganda could learn from other developing countries which could be applicable in the country context?
So yeah, Purva, one thing we need to also understand that yeah, Uganda has done quite well in few areas, including in the increasing its generation capacity. Where it is lagging is its demand side management, where uh, it has only 50% of electricity access presently, which is one of the lowest in Africa as well. Apart from that, now that the investment in the generation capacity has exceeded the demand, it has also created a lot of problem, which is also increasing the public debt as such, because it is not able to utilize its potential as such. There are a lot of countries who have done well, and presently the need for Uganda is to scale up its investment in these energy services. Like for example, if we see uh, one example I can say in the Rwanda, which has the similar kind of situation, but it has improved its energy access through a combination of on-grid and off-grid, strategy, where there is, urban cities and the population density is high. They have used the grid expansion method, but where the investment is quite high in connecting the people to the grid, they have created off-grid solutions. And the similar strategy has already adopted by Uganda, but they have to scale it up to a level where it can provide at least the universal access, and they are going towards it. But the problem is in the the investment. Presently, the pace of investment is not such. And as the Will also pointed out that Uganda need to now increase that investment through using the public resources by inviting private investors. And one of the example is in the Kenya is that they have invited the private companies to also participate in their DRE paradigm, where they have created models like pay as you go models, where they have distributed the solar systems and off-grid solutions, where they don't have to pay anything upfront, but they are right now paying as they go. And that has created a lot of impact in the rural areas. And one of the areas where actually Uganda is lacking a lot is in the clean cooking ecosystem. Presently, if you see more than 98% or so are using charcoal or wood as a cooking fuel, and that is very detrimental to the health as well as the indoor pollution. And one scheme I can think of is India's Ujjwala Yojana, which is very good in providing the LPG connections in a very providing the subsidies and creating a kind of an ecosystem which has actually increased the adoption of LPG from 65% to almost universal around 100% in I think 8 or 9 years of time period, and that is quite impressive. So these kind of the use case as well as examples are there present in the developing countries, but Uganda now have to think through and bring in the private investor into it. So I think that's where Uganda need to use the public resources which can be generated through other means to basically increase the pace of the development.
Understood. I think that's a very valid point that it essentially is about optimum utilization of resources, but within that, aspects like DRE and moving to clean cooking could be very useful for the country for the longer term. We also got a couple of questions in the Q&A box, and probably I'd like to bring Matthew in for that. So those are long questions, and for the benefit of time, I think I'll just take out the crux. I think what people want to understand is that you're talking about a lopsided return scenario for companies versus the government. How does that work in the longer term? And also, how do you think, is there still a decision to go ahead with the project? And within that, I think there was one more question on like the revenues being, if the revenues are lower than what was expected, but they still sort of outweigh the cost to the Ugandan government. So there is a net benefit. Then in that case, should the government go ahead with the project?
Yes, there's a lot of detail in there, and we're happy to give a general overview, and then also to follow up with anyone who wants to come back to us afterwards. Um, why has so in terms of like what decisions have and haven't been taken? Clearly the decision to go ahead with the oil and the pipeline has been taken. We From what we understand, the final investment decision on the refinery would be expected to happen this summer if it goes ahead. But obviously there are things that we're suggesting the Ugandan government would be helpful to look at. Why did they go ahead? I mean, I think in a previous report that I was putting out at Climate Policy Initiative in late 2020, we reckoned that the economics were marginal then. But that it was possible to go out to do some commercial renegotiation, and then it might just about make sense and so from what we can tell, that seems to have happened. Now, that didn't factor in the potential cost increases that we've seen. It didn't factor in the lack of availability of project financing. Um, and so, from an investor perspective, yeah, I have some questions because it was marginal, but there were these other sort of foreseeable risks. From a Ugandan perspective, I mean, that this has been we've looked at the fairly narrowly from the economic and financial analysis perspective, rather than anything else. But it has to be said that, many countries have done this in the past, particularly ones that have been at relatively poor. They see the possibility for a source of large amount of money coming in, especially when they have relatively high amounts of debt. Um, it's very it's very tempting. And there don't seem to be um, convenient alternatives to the oil that bring in the same amount of money in the short term. And so I can understand why it may be tempting, especially if you're in a situation where you don't have the luxury of long-term planning in the same way. Why you might sort of bury your head in the sand when it comes to the oil revenues, and then there. I guess there has been what seems to be a degree of wishful thinking about the transition. which again we've seen the transition playing out on my second slide. Whether we get to the net zero emissions scenario or not, there's still a significant potential downside. And so, whether this ends up being a net benefit to Uganda is a little bit of a bigger question than the analysis that we've just presented. Because Uganda, we reckon that Uganda spent, almost 2 billion US dollars on let's say ancillary infrastructure outside of this project, which was needed to get this project going. So there were roads, there was an airport, et cetera, et cetera. So if you look at this over a 20 or 30-year period, then I don't know. There is a question of as to whether it makes money or not. However, it's not, it's not a decision over a 20, 30-year period when you have a very high amount of debt. Um, and, I would say that if we if we were in a situation where there was a more effective route, internationally speaking, for reprofiling, restructuring, readjusting public debt, then many countries wouldn't be in this situation, right? So I think and there's another question about Tanzania, which would benefit to a much less degree from this project, even though they have their own debt concerns, because they, from what we've understood, they've waived certain transit taxes in order to get the project to go ahead. So even for both of the countries here, we have this lure, this promise of potentially significant revenues, and you know to an extent a drying up in recent times of some of the concessional financing. And so you can understand why some of the decisions were taken. Um, but what we've also showed is how easy it is for project risks and market risks to really start to undercut the position. And we think this is, if Uganda or Tanzania are going to make major changes in course, then they're going to need their support of their donors, and we would urge these guys to work together on that.
Thank you. And I think that brings us to the hour as well. But just one last question that is there, and it connects to what you were saying right now, like the support from the donors and support from investors. And we have answered that question during the course of the webinar, but in case you want to add anything, or when we talk about, their recommendations on multi-year investments in climate resilient, electrified industrialization. So a lot of money would be required. And in the face of the potentially declining aid, what ways do you suggest that the country can scale such investments for development? We'll answer a bit of it, but in case you want to add anything on that.
Well, there's many ways in which they could be structured, I suppose. But I guess we haven't gone into those things specifically. It's really around how do they use public money, and whether this is, and I guess there's been a lot of focus on the potential additional costs, human costs, environmental costs in relation to the oil resources themselves. Um, However, at the moment, it seems likely that oil is going to flow, and then there's a question of how you use that money. And as Will said, a significant amount of the oil money in the short run seems likely to be pledged to Vitol to support the loan to build the refinery. If they don't go ahead with the refinery, well, then they'll be able to export more oil. There will be more oil revenue to share, and then Uganda will be able to get access earlier to some of that oil money in order to support some of these other resilience investments. So that's not to downplay some of the human and environmental costs, which other people, wasn't a focus of our project, but other people have looked at in detail. But you know, if the oil revenue is to flow, then I think there is also some important questions around how that gets managed and what it's spent on.
Perfect. Thank you. So thank you all for sharing these such important insights with us. I think it's about balancing and optimizing the public resources. It's about a long-term planning, the possibility of long-term planning, like Matthew was mentioning, and the need for long-term planning, and not just look at the short-term revenues and make your policy and decisions based on that. Thank you everyone for joining this webinar today. Hope you find it helpful. If you have any more questions, please feel free to reach out to the report authors, and their contact details are there in the report. And I think that's all from us. Thank you, everyone. That's all. Good night.
Thank you very much.